Hello everyone, so this is part 1 of 2 videos that I will be uploading on the double entry system for expenses and revenues. Before we start doing anything on the double entry system for this particular topic, I want to make sure that we understand a few things. I want us to understand the concept of profit and loss by comparing revenues with expenses. Also, I want us to be able to see the effects of profits and losses on capital and the relationship to the accounting equation. So the nature of profit or loss, to an accountant, profit means the amount by which revenues are greater than expenses for a set of transactions. So in order for a business to make a profit, their revenues must be greater than their expenses. A very simple concept to understand, and of course if you reverse this definition, that would equal to a loss, meaning if your expenses are greater than your revenues, that would equal to what I said, which would be a loss. But what exactly are revenues? A term that we have been using so far, perhaps that you might be able to understand even easier and faster, would be sales. The term revenues means the value of goods and services for a set of transactions. So if you have a clothing store, each item you have at the store should have a price attached to it. And every time you sell one of those items, you acquire revenue from that particular sale. So the more items you sell, the more revenue your business makes, and you want to make your revenues as high as possible. While expenses, the term expenses means the value of all the assets that have been used up to obtain those revenues. So if you have a clothing store, one of your expenses very likely will be salaries. If you do not have salaries, if you do not pay salaries to someone, then perhaps you have expenses such as rent or any common utilities paid. Profit. So to give you an example, let's say that for a particular business, it has revenues of $100,000, while expenses are deducted, and let's say that for this particular business the expenses amount to $70,000. In this case, the profit would be $30,000, given that we do $100,000 minus $70,000 for an equivalent of $30,000, which we are calling our profit. The reverse happens. If revenues are higher than expenses, then let's say that in this particular case our revenues are $60,000, while our revenues still being deducted amount to $80,000. In this case, we can clearly see, as I stated at the beginning, that the revenues is clearly greater than expenses, so this will lead to something known as a loss, specifically $20,000 in this case. So how does profit or loss affect capital? Let me give you a scenario for you to understand how profit or loss affects capital. So on January 1st, the assets and liabilities for a firm are as follows. Assets: fixtures $10,000, inventory $7,000, cash in hand $3,000. Liabilities: accounts payable $2,000. Given the accounting equation, capital equals assets minus liabilities, we can add all our assets which we have available and then add our liabilities, which is only one, and do assets minus liabilities, which would be $20,000 minus $2,000, and that would equal to $18,000 in capital for this particular business as at January 1st. Keep in mind this $18,000 is for January 1st as we move into the other slides. So let's say that during January, the whole of the $7,000 in inventory is sold for $11,000 cash. On January 31st, the assets and liabilities have become assets, fixtures $10,000. Inventory is now zero because all of it was sold. Cash is now $14,000. Liabilities, accounts payable remain at $2,000. We use the same accounting equation whereby we need to add our assets and subtract our liabilities to know what the capital is in this case. In this case, our assets add up to $24,000 and our liabilities, which is $2,000, is subtracted, and we end up with $22,000 in capital as at January 31st. Remember that $22,000 is for the end of the month. So $18,000 was the capital as at January 1st. Then $22,000 was the capital as at January 31st. It can be seen that capital increased from $18,000 to $22,000. $4,000 increased because the $7,000 inventory was sold for $11,000. A profit of $4,000 was acquired in this case. So we can say that old capital plus profit equals new capital. So if we throw in a few figures, meaning old capital $18,000 plus the profit of $4,000, it will equal to $22,000, which we are calling our new profit. On the other hand, a loss would reduce the capital, so we need to say old capital minus loss equals new capital. I do not have an example with a loss in this case, but you can insert any number and you would get the idea of how the new capital is calculated if and when we get scenarios whereby we have a loss.